Hi, welcome to Academic Market Insights. I'm Dr. Russell Rhoads, flying solo today. I'm recording on a Sunday. Actually, I'm recording on the Sunday just before the Bears take on the Rams in the playoffs, and the day before IU plays in the national championship game against Miami down in Miami. So on edge over here. On Friday and most Fridays, I am involved in the Vol Views podcast with the Option Insider Network. And one of the other co-hosts, Andrew Giovinazzi, he was talking about how he felt 2025 was very different than previous years, and that VIX at times was behaving a little bit in a different manner than one would expect relative to what was going on with the S&P 500. Now, I know that VIX, has been higher than people had expected when we were making all-time highs in the S&P 500. Although it wasn't that far out of the realm of possibility, there was one big difference with respect to the correlation between the S&P 500 and VIX, and a few other observations that were worth looking at. So I'm gonna pull up the slideshow here and talk about what that correlation looked like, but then also, we got the lowest correlation this century, and just some other observations, but just also to talk a bit, use this as an opportunity to talk a bit about how VIX does behave, and how just because the S&P 500 goes up doesn't necessarily mean that VIX is going to go down on the day. Now, I'm going to talk about the correlations, and then a slightly different figure, but there is a relationship there. It's the daily relationship. And typically, about 80% of the time, the S&P 500 and VIX move in the same direction as each other, depending on the time that you're measuring, and depending on whether you're looking at days the S&P 500 is higher or days the S&P 500 is lower. Those numbers can vary. Go look at the average VIX versus S&P 500 performance. That it shows that VIX was not behaving as differently as one would expect, even though the S&P 500 was having a pretty good year. And then take a look at VIX when we have all-time highs, what the average is. But also, I created a histogram to show what the handle for VIX was each time we reached an all-time high. And 2025's range is very different than the historical range. So starting out with the annual correlation, so just taking the daily percent change of the S&P 500 and comparing it to the daily percent change of VIX, you can see I highlighted at the bottom right there. In 2025, the relationship was a minus 0.8697. That was a whopping 0.0008 lower. And we're talking about inverse relationship, so the more inverse, the lower than what I guess we would call the previous record in 2015. You can see there are a lot of 0.7s, 0.8s there. If you look over at 2003, that's kind of an interesting one, and I'll get to that in a minute. But that's kind of an interesting one with that really low correlation. We were coming off of probably the nastiest bear market in the last 20, 30 years as far as length and depth, which may explain a bit about that very low correlation. Like maybe the stock market was going up, people weren't buying it, and maybe VIX was going up on up days as well. We'll see that breakdown in just a minute. There's the annual correlations as a chart. Looks like, I can't ever remember, it's stalagmites, whatever, from back in grade school, whichever ones are hanging down from a cave. That's what kind of looks like here. I did darken 2025. You can see it's a bit lower than that 2015. Showing this in numbers probably made a lot more sense in this chart. But you can see most of these are falling. A big portion of them are falling very close to the 0.8 or below in the 0.7, 0.8 range, minus 0.7, 0.8 range. As far as the average VIX S&P 500, the average VIX versus S&P 500 by year, you can see I'm starting over at year 2000, and you can see 2000, 2001, 2002, S&P 500 was under pressure each year, and VIX averaged really nice performance. In 2003, as I noted, back here, we had that very low correlation. That may be coming off of a couple of bad years, and then the S&P 500 working its way higher. I would also say that that's something that happened in 2009, and maybe a little bit in 2023, not as much in 2023. But this 18.96, it's not out of the realm of possibility based on the S&P 500 being higher, but it's a little unusual after coming off of a couple of years of lower volatility and the bull market continuing on. I know we've got a pullback in April and a lot of concern hanging over the market as far as how the tariff situation was going to work out. But as we got toward the end of the year, VIX started to get in the 14, 15 range, a lot more normal for making all-time highs. So I broke out the by year, how often both moved in line with each other, which would be synced, the light part of the chart on the top, and how often they move as expected in an inverse relationship. You can see big inverse relationship back in 2008. 89% inverse relationship. You can also see this year 79%, which is very close to normal. The correlations were very low, but as far as days where the two moved in line with each other or moved opposite of each other, this 2025 was very close to the average. I know there's always astute folks that point things out, and I know that these numbers don't go up to 100%. If the S&P 500 was flat or VIX was flat on the day, that just got thrown out. So these do not sum up to 100%. Now, I took it a little bit further, and I took a look at how often, when the S&P 500 is higher, do they move in opposite directions, which would be how often when the S&P 500 is higher, does VIX move lower, and how often when the S&P 500 is higher, do they move up? And first off, when the S&P 500 is higher, you can see this past year, 81% of the time they moved in an inverse relationship, a little bit higher than the overall average. This number is a bit higher than the overall average. You're more likely, if the two are moving in the same direction, for this to occur when the market is moving higher. And that is often an instance where maybe the S&P 500 is moving higher, but maybe we've got an employment number on the horizon. Maybe Trump's getting ready to make a big announcement about tariffs. So the market, maybe it's moving higher, but people are positioning in case we get a quick drawdown in the S&P 500. That would involve buying S&P 500 put options, which would push VIX a bit higher. So we've got that inverse relationship elevated in 2008 as well. Keep in mind, that when the S&P 500 was moving higher, you probably had folks that were not, that maybe were thinking this is the end of these nasty moves. Also in 2015, over 91% of the time they moved opposite of each other, which is interesting because that was the higher correlate. That was the higher or the lower or closest to the lowest correlation to 2025. And then when things are lower, as I mentioned, you see a lot more inverse in the 70s along that line than in the 80s, like you do here for the higher. And that's just when the S&P 500 is lower. You are sometimes when the S&P 500 is lower, that could prompt selling of S&P 500 puts, people taking profits on a position. So, in that case, you'd have the S&P 500 lower and VIX, VIX moving lower as well, and that would result in them being synced. And you can see 35% of the time that the S&P 500 was lower in 2022, VIX was lower as well, and that really would have been, that could have been an indication of the market moving down and people taking profits on long puts as opposed to panicking and buying insurance. So looking at the handle, and for those of you that don't speak trader, the handle is the number before the decimal. So if VIX closed at 1460, we would say it had a 14 handle. And you can see the VIX handle when the S&P 500 was at all-time highs. The average VIX close since the first day of the year 2000, when the S&P 500 makes a new high, is around 1410 or so. You can see the most common outcome is 12. And we did have a whole lot of nines way back. Yes, VIX, it hadn't happened in a while, but VIX can get to relatively low levels. Those 20s, those are mostly in the early days of VIX. I believe if I ran this thing starting at 2010 instead of 2000, that you would see a lot fewer. This thing would not go as far to the right on your screen. You definitely would be clustered a bit more in the teens. Now, we're going to take a look at this chart in 2025. And it's a lot. There's only 13s, 14s, 15s, and 16s. But you can see the most common close was 16. The average, I believe, the average VIX close when the S&P 500 made an all-time high in 2025, I believe it was around 1580, 1590. So much higher, about 2 points higher than the average over the long period of time. And again, if I threw out these 20s, which really did occur in the early part of the century, and the zeros or the noughts, I think on the Beverly Hillbillies they used to refer to zero as naught, but the first decade of the century was when most of those occurred. So the closing handle has been mostly in the teens or below the teens when we've made all-time highs. Seem to be a bit elevated. All of them were in the teens in 2025, but on average, much higher than the average VIX close when we hit all-time highs, as you can see here. And so there, in summary, just some observations on 2025 by a very small amount. The correlation between the S&P 500 and the VIX daily price changes was the closest it's been to -1 on record in 2025, eclipsed the 2015 number by very little. In fact, if you start rounding, they look like they're equal. VIX did average 1896 in 2025, despite bullish behavior from the S&P 500. We did have some other examples of VIX being relatively elevated, even though we're making new highs and had a nice bullish year. But those usually came after we had a bearish year or a bear run. So I think there's some significance in there, not dramatic significance, but definitely going along with what Andrew was thinking. You definitely an unusual year for VIX. And then finally, that VIX closing handles in 2025 when the S&P 500 was making new highs, it really did. That distribution varies from that normal behavior of VIX during all-time highs, where a good portion of the numbers, in fact, I think over half of them are below 14, and I think almost a quarter of them are below 12. Or are 12 and lower. Maybe a third of them are 12 and lower. So the absolute level of VIX when we were making these highs, and you can attribute that possibly to people not believing that the market should be as high as it is, believing that because of excessive valuations, they're going to take advantage of the market being up and buy some puts to hedge against the down move. And then when we've been getting the down moves, they just haven't occurred to the extent where people were taking profits. So there. All right. With that, as always, our website is still in the process of getting up and running. You're at our YouTube channel. Please subscribe. Now that we're back on the clock and school is going, we're putting out about 3 videos a week. We're getting ready to do a very special series that I'm not gonna share without Dr. Ademiak here. If you've got any questions, suggestions on what we should be doing here, academicmarketinsights@gmail.com. And then also, whenever we're up to anything together or individually, it gets highlighted on Twitter or X, whatever you want to call it, at Acom KT Insights. That was the closest to academic market insights I could come up with on a Twitter. And if you made it to this point, you owe us a like. So hit that like, and if you haven't subscribed, definitely start subscribing.